Good evening, everyone. Can you all hear me?
Yes, we can.
Thank you. Welcome to our facet class. My name is Laram Caesar. I'm not alone. I'm with Mr. Mkokoni, my colleague, who will teach the module together. Please know that the class will be recorded, so you'll be able to receive the recording at the end of the session or tomorrow morning. So today I will first present a bit of basics on PPE, which is study unit 11 that will focus on. So what is the objective of the class? The purpose of today's class is to learn what is PPE, which is property, plant, and equipment. So every time you see the PPE, know that it stands for property, plant, and equipment. We'll also discuss how to determine the cost price of PPE, how and when to record the purchase or acquisitions of PPE in the accounting books. Concept of depreciation, methods of calculating depreciation, other important concepts when dealing with PPE. How to deal with disposal of PPE, meaning how to deal with the sale of PPE. Then lastly, my colleague will go through with you on class exercise on PPE. So there will be a few questions that I will discuss with you just to show you how to apply the basics that I'm going to give you into the questions. So now, what is PPE? We've got tangible non-current assets, and they are held for use in the production and supply of goods and services, for rental to others, or for administrative purposes, are expected to be used for more than one financial period. So if an asset will be used for more than 12 months, remember financial period equals to 12 months. So if something that will use for more than 12 months, things like the car, the building, the machinery, that you use in your company, those things will be called tangible asset, meaning that they must be tangible. So we are not dealing with intangible things like your copyrights. No. For the purpose of this lecture, we are focusing on tangible assets. PPE are classified as non-current assets because of the following. It is not the intention of the entity to sell non-current asset, but to use these assets over the long term in its business operations to earn an income. Secondly, non-current assets are those assets with a useful life of longer than 1 year, as discussed before. Example of tangible assets, as I've indicated, is your land and building, machinery, equipment, vehicle, and furniture. So these are for the use of the entity. For example, if your company your company sells vehicles, your vehicles that you sell will not fall under non-current asset, but will fall under your inventory because you'll be selling those vehicles, expecting to sell them within 12 months. But the vehicles that you use in the business and that belongs to the business, those are the ones that you can put them as non-current assets. So you need to understand the difference depending on the product, on the business, on the kind of business that is being operated by the company. What is manufacturing, what will be stock, and what will be their non-current assets. So be careful of that. So if they tell you that the company is in the production, they produce cars. So you'll know that the cars that they're producing, they're going to sell them. But the trucks that they bought to deliver the goods from one place to another, those ones will fall under your non-current assets. And please, if you have any questions, kindly post it on the chat, but I will also allow you to ask questions. So how do we determine the cost price of an PPE? Cost price consists of purchase price less any discount. which is your trading discount, settlement discount receipt. Please note that. The cost price is the selling price that you've bought. It's like the money that you've paid to acquire that asset, less any discounts. Transportation cost. So the money that you spend when you're going to deliver for the delivery of those non-current assets, then you include it. Any cost making the asset ready for its intended use will also be included as a cost price of an asset. Then, cost specifically excluded includes interest charged. If you have bought something on loan and you're paying interest on that asset that you have bought, you will have to exclude the portion of the interest will not be included in the cost price. So whatever if they said for you buying that truck for the company, they are charging you 12% per month. That 12% per month interest, you're not going to capitalize it. You're not going to add it on the purchase price, but you will record it as a finance cost on the loan. I hope you understand. Maintenance cost, you're also not going to include that as part of your purchase price. You'll only expense this cost. So, how and when to record the acquisition of PPE in the accounting books? Purchase of PPE is recorded in the applicable asset account at the cost price. Recording of purchase of PPE, it is done on the date of purchase, the date of the transaction that took place. If the fixed asset or tangible asset was purchased for cash, record these transactions in cash payment journal. I hope you remember. So anything that has to do with cash, remember, you post it under cash payment journal. The asset will be debited and the bank will be credited if you are buying in cash. So you need to remember your T accounts that we have discussed previously to say in which side does the asset increase and which side does the asset decrease. And remember, since asset, which is your PP that you are buying, and the bank an asset, it means one is going to increase, the other one is going to decrease, meaning that your bank will go down because you are taking out money to purchase a new asset. Then you create a new asset by debiting your asset account. If the fixed cost or tangible asset was purchased on credit, record these transactions in a general journal. Remember, if it's bought on credit, you cannot include it as cash payment journal. You won't include it in that subsidiary because there's no cash involved. Therefore, means that you're going to go to your general journal to record the transaction because you bought this on credit. The asset will be debited and the trade payables control account will be credited. Remember, if you are selling, you are buying something on credit, you purchase on credit, it means you are raising a creditor, meaning that you are owing someone. Therefore, we need to increase your liability by crediting it with the amount of the sale. And the asset will be debited as we are increasing our asset as we are buying a new asset. It can be any of the PPE item depending on the entity. So now let's discuss the concept of depreciation. Before I continue here, can you guys type on the chat for me what do you think? When you see the word depreciation, what is exactly a depreciation according to your own understanding? So I'll give you just a minute to post on the chat to explain in your own words what is depreciation. What and how can you explain it to your fellow students who are new in the class? I've seen Petunia has started. So I want to ask something interesting here. Can we depreciate land? Thank you. Very interesting. I'm happy that you guys are with me. So, like you have indicated, depreciation is a systematic allocation of depreciable amount of an asset over its useful life. Yes, is a loss in value because when you use something, it loses its value. And then how do we calculate this amount? It will be your cost price less residual value. Residual value is an estimated amount that the entity expects to receive when disposing the asset at the end of its useful life. So it's that amount that you think that, you know what, when you are done using this asset, at least, let's say for a car, you know, you depreciate it for 5 years, but you know that you can't just dispose it for free. Maybe for this car after 5 years, instead of getting the 100,000 that you used to buy it, you might get your 10,000. So that is your residual value. That is the amount that you expect to get when this asset has ended its useful life. If residual value is zero, depreciation amount equals to cost price. Depreciable amount, the depreciation. This is the amount that you're going to use to calculate your depreciation. Depreciation is an asset, is an expense. So it goes to your profit and loss account as part of your expenses. Depreciation expense must be calculated for each accounting period from the date the asset is available for use until the asset is fully depreciated over its useful life or disposed. All depreciation expenses that we calculate for each accounting period are added together. And when you add this depreciation from year 1 to year 2 to year 3, we call this amount combined accumulated depreciation. Accumulated depreciation is a contra asset account. We will do examples to explain how this is being recorded. So can you type for me on the chat different methods that we use to calculating depreciation? So how do we calculate depreciation? What are the available methods that you know that we can use to calculate a depreciation on an asset? Sorry. Thank you. I didn't say I was muted. So, depreciation using straight line method is calculated on the cost price every year. And we will give you the percentage, which we call it depreciation rate, that you need to use to depreciate the asset. So read carefully. And please know that if we did not give you a residual value, it means there is no residual value. But make sure that you read on the scenario. If there's any residual value, put there. Either it's zero or it will be 10,000 or 20,000. Please make sure that you check this because you need to less it from the cost price of an asset when you calculate the residual value. Can you all hear me now?
Yes, we can.
Oh, thank you. I see someone says there's something. Thank you. Please bear with me. I've got a bit of flu, so my voice is different today. Another method is called depreciation using diminishing balance method. And this method is said you calculate depreciation is calculated based on the original cost price with less depreciation accumulated over the period the asset have been used in the business. So still, you need to take your cost price less your residual value. But here now, before you calculate the depreciation using diminishing balance for that year, you need to also less any available accumulated depreciation. Then you're going to multiply by depreciation rate. What does it mean? So let's say for the first year, we gave you 20% as your depreciation under the depreciation diminishing balance method, meaning that in year two, before you calculate depreciation for that year, you'll take the cost price, you less your residual value, and the accumulated depreciation from last year before you calculate now. This one to get a depreciable amount for the current year, which will be your year two. Then you times by your depreciation rate. While when you use straight line method, the cost price they said is 100,000 and you depreciate by 20%. So every year for the next 5 years, you'll do 100,000. So it will be 100,000 times 20%. Every year, you don't change the cost price as long as if they said there's no residual value when you use straight line method. But when you use diminishing balance, so they tell you that this asset is 100,000, zero residual value, and it's 20%, meaning that what will be the depreciation in year one using diminishing balance method? Cost price is 100,000, residual value is zero for year one. Please post on the chat.
And they're saying, please repeat the question.
Yes, I'm typing here. Can you see it there? So cost price, CP cost price is 100,000. Depreciation rate is 20%. Calculate year one depreciation using so you're going to give me two answers and with straight line. for year one. So I need 2. So indicate when you put your amount, if this is for straight line or is it for diminishing balance method for year one. Then let's do year 2 for both methods. So now you see, thank you very much. So now you see the difference. So if you haven't read carefully in your scenario, which method they are using, you will get the depreciation incorrect. First year, they will look the same, but in year 2, there's a 4,000 difference when you use diminishing balance method. So please be careful of that when you read your scenario. Make sure that you have read carefully what they say. And also be careful of the year, the period. So you need to look, as we indicate always, you must know, number one, when you read, what is the financial period of the company that you're working with? When does it start? When does it end? When did they buy an asset? Why we are saying that? Because you might need to apportion if the asset was bought during the month, during the financial period. So let's say their year starts in 1 Jan to December, but they bought that asset in June, meaning that from June until December is only 6 months. So you'll need to
Hi, Clara. You
you'll
are
need to
muted.
apportion that. Yes. No, I was just taking a sip. Thank you all. So you need to be careful of that. So I'm talking a lot, so the cough. Hence, I keep muting. Then you also have depreciation using unit of production method. Here, the actual units produced during the year divided by total expected units to be produced over its useful life times cost price less residual value. It's almost the same, but here they will give you expected number of units that will be produced by that machinery for its entire useful life. So this one, they use it sometimes for machineries that are producing some stock in the manufacturing companies. So that company, in the scenario, they will indicate their depreciation method and give you expected units that this asset is supposed, this machinery is supposed to produce every year, and also for their entire useful life. And you're going to also be careful of the residual value. If it's given, if it's not, then you put 0. Cost price less that. So be careful of that. So we can use any of the methods in our assessment. So you need to master all of them. And this will also be your basis for accounting for second year. So then you've got depreciation on your assets. So there's a different things that you need to take into account when you depreciate an asset. Is it new, old, or are you selling it? Using which method that has been used, either diminishing, balance method, or straight line. These are the common two depreciation method that we usually use. But you know there's that third one, so don't ignore it. So when the asset is sold, calculate depreciation from the beginning of the accounting period until the date that the asset was sold. So let's say this asset has been with us for 3 years and our year is from 1 Jan to 31st December, and we decide to sell this asset on the 31st of March. So meaning that you'll need to depreciate it for 3 months because that's when we sold the asset. The remainder of 9 months, it means that asset has already been out of our books. So you need to check the asset that you're dealing with. Is it an old asset? Are we selling it? If we are selling it, when is it sold? So that you can know that when to stop depreciating and how many months you need to use to apportion your depreciation for the current year. When there's a new asset, calculate depreciation from there. Then the asset was purchased until the end of the accounting period. So let's say the asset was bought in 1st of June until December, 6 months. So you need to multiply your 20,000 that you got for your straight line method times 6/12 if the asset was only bought in the middle of the financial period. Asset always equals to 12 months as long as the asset has not reached its useful life and has not been disposed of. So if this is the asset that you had from the previous financial period, it means in this current financial period, you'll use the same method that you used last in the previous financial period. And be careful if they were using diminishing balance method or straight line method. Usually the company will tell you when they change from one method to the next. But for the purposes of this module on first year, we don't usually change the depreciation period in the middle. So yeah. There are things that you need to know about PPE. Yes, we'll do an example, Yanga. Carrying amount of an asset. This is important because every year this amount you need to adjust it, and this amount will appear as part of your PPE in your statement of financial position. So it will be your cost price less your accumulated depreciation. Proceeds from sale of an asset is when you are disposing of an asset. And this refers to the amount to be received from the sale of an asset. So you need to remember this concept. Profit on and loss on sale of an asset is when you are selling your asset equals to the money that you expect to receive less your accumulated depreciation on the date of disposal. And this will give you either you made a profit or a loss. Can you all hear me? So when I mute, please just know that I will be taking a sip because I've got a bad cough. If proceeds is greater than carrying amount of an asset on the date of disposal, it means is a profit has been made on the sale of an asset. So now, for example, we will do an example. I think my colleague will do an example on this proceeds. So let's say today you are selling this asset in here, the same asset that we had of 100,000. We are using straight line and we bought it at the beginning of the financial period. And we decide to sell this at the beginning of year 3. So as you have indicated, you remember now our amount. So if we are using straight line method, what will be our carrying amount at the end of year 2? Can you please post it on the chat? I'll remind you, I will go back and show you the amounts again. So please know that the carrying amount of an asset equals to your cost price less accumulated depreciation. So meaning you're going to subtract depreciation from year 1 and year 2 to get the carrying amount at the end of the year 2. So thank you. So now I want you to, let's say now we are selling this asset in year 3, beginning of year 3. With that, having that in mind, the carrying amount, we are selling it for 80,000. So this 80,000, it will be called your proceeds or selling price. So what will be your profit and please, if we are leaving you behind, stop me. Who's there? And we will assist you before I finish. So I'm doing this example to try to show you how missing the important information on year end and also the method that they use. It means if you continue, you'll get all your answers incorrectly if you have used incorrect method. as per the question. So, Oloitu, please pause there. Where did we leave you? So we can explain to you. So I will open up your mic, raise your hand, then I will open your mic quickly, then we can help you. Alrighty, you can raise your hand so I can see you and you can advise. Yes. You can unmute and please explain where we have lost you.
Greetings, everyone. I was looking at the slide. I wasn't looking at the chat that you posted some questions.
Oh, that's why you felt lost. So
Yes.
now, so some students wanted to do an example. So I was doing it, also providing an example here. So we had an asset that we bought for 100,000. And then we are depreciating the asset with 20% using both methods, using a straight line method and also diminishing balance method. We're trying to show you what can go wrong if you use incorrect formula that was not given on the scenario. So when you read the scenario, the assessment, you must be carefully read what method they're using, because the balance that you get from diminishing balance method and straight line method, they are always different when you get to year 2, year 3. So when you sell that asset, the carrying amount and the profit that you make will be different depending on which method you are using. So hence you see people posting on the chat. Are you happy?
Yes, ma'am.
Thank you. And Albertina, let me unmute you. You can speak, Albertina Pala.
Hello?
Yes, we can hear you, ma'am.
Yes, ma'am. I can't see where you're doing calculations. It's
No,
only
I'm
the
not doing.
notes.
Yeah, I'm not doing the calculations. The
Okay.
students are doing. You must have your pen, paper, and calculator ready. So
Because
you can
I
read on
entered
the
late.
chat.
Okay.
Yes. So did you hear me when I was explaining to Oloit that we have an asset with a cost price of 100,000? Then we
Okay.
use 20, is depreciable rate is 20%, and we calculate depreciation based on straight line method and
Yeah.
diminishing balance method. So what we have discussed is that in year 1, the depreciation will be the same.
Yeah.
However, once you get year 2, for
Mm.
straight line, it won't change. However,
Yes.
when you use diminishing balance method, you'll need to say cost price less accumulated depreciation from year 1 before you calculate for year 2. Hence, the difference starts showing in year 2. So now we're just trying to say what is the carrying amount at the end of year 2, and if we sell this at the beginning of year 3, will we make profit if we sell this asset with 80,000? So this is where we are.
Okay.
Okay.
Thank you.
You're welcome. I'm just checking on your chats. And Mr. Mkokon will also tell us if you guys are right. Remember, for straight line method, we had agreed in year 1 is 20,000 minus 20,000. So accumulated depreciation at the beginning of year 3, it will be 40,000. So we've got 60,000 as our carrying amount. And when we sell it for 80,000, we will make a profit of 20,000. Happy. Then when we use diminishing balance method, You guys said the first year depreciation is 20,000, the second year is 16,000, meaning that we've got carrying amount of 64,000. So when we say 80,000 less 64,000, we made a profit of 16,000. So Nomvuyo, I don't know, Princess, if you can see the slides. If not, you can log out and come back again. So anyone, can I give anyone to explain the difference between residual and carrying amount on the chat? Please help Maleka, because you guys know this way better than me these days. So Malika wants to know the difference between residual value and the carrying value. So anyone can do that, then I will check on the chat. So now you need to remember that when we get that profit and loss on the sale of an asset, if is an profit, it goes to your profit and loss and it becomes your income, not an expense. So it increases your income. So you need to remember which side does the income increase on, because it's not an asset, you are making money. But when you made a loss is when your proceeds is greater than carrying amount. So let's say, for instance, we sold the asset not for 80,000, but we sold it for 40,000. On a straight line method, you'll have a 20,000 loss. So you need to know that how you're going to record this amount in your financial statements. Then the other thing you need to know again is asset realization account. This is a temporary account only used to close off cost price and accumulated depreciation when we sell the asset. It records the proceeds on the sale of an asset to determine profit and loss on the sale. We're almost done. How to deal with disposal of an asset? How do we deal with selling the asset? We are the company. We want to sell the vehicle or machinery or that land and building. How do we deal with this transaction? We already said that you'll need to determine your carrying amount on the day of sale. And before you determine that carrying amount, you need to know that what is your total accumulated depreciation from since the asset was bought until the date of sale. Meaning that if your year end is from 1 Jan to 31st December, and you're selling on 31st of March, you need to also include the depreciation for the 3 months, which is Jan, Feb, and March. That should be included in your accumulated depreciation so that you can get the correct carrying amount of the asset. So there are 6 steps that we have put here on how you can deal with this. Please have this ready when you deal with PPE. Record the depreciation expense on the disposed asset from the beginning of the current period until end of the disposal. Transfer the total accumulated depreciation of the disposed asset from the date the asset was purchased until the asset was sold to realization account. So you're going to deal with this realization account, which we called it temporary. We are trying to remove this asset from our books altogether. Then you're going to also remove the cost price of the disposed assets to the realization account. Record the proceeds from selling the asset to realization account. Then you will calculate your profit and loss. This we have discussed as well. Thank you very much. Any questions before we deal with the revision exercise for today? Any hands before my colleagues takes over? So that we don't leave you behind. So we will share these slides with you when we share the recording. Okay, I see there's a hand. Let me go unmute you, say Tumelo. Tumelo, you can speak?
Question from Tumelo.
Yes, he can speak. Carol, you
Yes.
can speak. Sorry.
Am I audible?
Yes, ma'am.
Okay. With the example that we were doing right now, with the asking the profit or loss of the asset that we were doing using the diminishing and the straight line method. I want to understand where you got the 16,000 from the diminishing balance method, because when I looked at the slide, it says to work out the profit or loss, you take the proceeds and you subtract the accumulated depreciation. So the proceeds that you gave us were 80,000. According to my understanding, was 80,000. Then the accumulated depreciation for the diminishing balance were 36,000. So how did we get to the 16,000?
Anyone who wants to respond, can you raise your hand so you can explain to your fellow student? Let me check before I pick you. Anyone who wants to explain to us? Anyone who's willing to explain to Carol? Can you raise your hand so I can unmute you? Oh, you guys, are you with me? Or you also don't know where we get the 16,000? Anyone who knows where we got the 16,000, what she's talking about? So, okay, we've got someone who wants to explain to us. Thank you. Otherwise, I feel bad, like I can't be talking alone. I'm coughing a lot, so I need you guys to help me teach. Thank you. So you can go on, Masejo, and explain to our fellow students.
From what I understand, you subtract the 20,000 from the 100,000 that we were initially given. And then that's when you use the 20% that we also got from the question. You multiply that with the 80,000 you got when you subtracted the 20,000 from the 100,000. That's how you get 80,000. And from there you get 16,000.
Um,
Am I making sense?
no, I hear you. Maybe my question was not, I didn't phrase it right. I thought we were calculating the profit or loss of
Oh,
the,
no.
yes, because I saw most
Yes,
people
we
were
did.
answering.
So we were calculating the profit and loss.
Yes. So what was the answer? Because we didn't get the answer. Because we got the 40,000 of the straight line method, if I'm correct, but we didn't get the answer for the diminishing balance, the
For
profit
the
and loss.
when you're using the diminishing what? Balance method, it's 36,000, right?
Yes.
Yes,
Accumulated depreciation.
it's from both years, both those years, year 1 and year 2, right? Because the
Yes.
first one you get 20,000 and from the second one you get 6, and that's how it ends up being 36,000.
Okay, maybe guys, maybe I'm not making sense. Because Ms. Msiza asked us to calculate when she gave us the 80,000, right? She asked us to calculate the profit or the loss, right? Then most of us with the straight line, we got 40,000. I'm assuming we took the 80,000 and we subtracted the 40,000. Yeah, the accumulated depreciation. With the diminishing balance, I thought that we're going to take the 80,000, then we're going to subtract the 36,000, and we were going to get the is it 44,000 or something? I want the profit or loss amount for the diminishing balance method.
Can we also try Ntswaki? Do you want to attempt? Then I'll also allow Nemi as well.
Okay, ma'am, let me try and explain. From the beginning, we're given 100,000, which was the cost price of the asset. And then the rate of depreciation is 20%. For you to get accumulated depreciation, you're using that 20%. And by getting the accumulated depreciation, you take 100,000 times 100 times 20%, and then you get 20,000, which is your accumulated depreciation for year one for both methods. But when you do diminishing balance, you take that 100,000, you minus the first year, which is 20,000, and then to get to the second year for a diminishing balance, you time it by 20%, which you will get 16,000. So, Ms. Msiza, for us to calculate the profit, he said we are disposing the assets for 80,000. So meaning you take that 80,000, you minus your carrying value, which is 64,000. Then you get your profit of 16,000. I don't know if I tried.
Okay, no, I think I understood you. So you said you have to subtract the carrying value before you subtract the depreciation as well.
Now, remember we were giving initially the cost price of the asset is 100,000.
Yes.
And then when you calculate your accumulated for year one with the depreciation value rate of 20%. For year one, on both methods, you get 20,000.
Yes.
But on year two, you are gonna get 20,000 on straight line, and on the second year, you're gonna get 16,000.
Yes.
From your question of how did we get 16,000 when Ms. Msiza was talking about the profit, she said to us, we are now disposing our assets for 80,000 rand.
Yes.
And we said our carrying amount is 64,000, meaning you're gonna take your 80,000 that you are saying you are selling these assets for, and then you minus your carrying amount, which is 64,000, which you get your profit of 16,000.
Okay, no, I understand. Thank you.
Thank you.
Thank you, Ntswaki.
Anyone who wants to? Quentin, do you want to assist as well?
Sure, am I audible now?
Yes, sir.
Okay, so my answer was 28,800 and it appears to be wrong. The way I understood the question was we're selling the item at the end of year 3 for 80,000. So our carry amount at the end of year 3 is, pardon?
At the beginning of year 3.
Oh, gee, at the beginning, sorry. Okay, so at the beginning of year 3, then it would be 16,000. Okay, should I carry on or be happy with that?
Hello, Princess Walaza. Unmute and ask your question.
Hello, my name is Novio Alaza. I wanted to ask about the diminution method. I'm still lost with the diminution method. I've read the material, but it's still not making sense. I'm still
Remember, the
confused.
diminishing balance method is where you calculate your depreciation on the cost price less depreciation that has been accumulated over the period in which assets has been used in the business. Like for example, like when we said year one for both straight line method and diminishing balance method, the answer will be, if I remember, it was 20,000. Because it was 100,000 for both times 20%, then it will be 20,000 for both method. Then year two, because remember diminishing balance method, you take your cost price, which was how much? It was 100,000. You will less residual value if there is any residual value given, and on that question there was no residual value, it was zero. You less accumulated depreciation, which was how much? It was 20,000. Now we are on the second year, and you will get depreciable amount, which is 80,000, and you times your depreciation rate of 20% times 100,000, then you will get your 16,000. Are you happy? Hello, Princess?
I'm still, but I'm getting it. I'm still.
Because diminishing balance method is your cost price less your residual value if it's given less accumulated depreciation times depreciation rate. If the asset is bought during the year, you multiply by the number of months divided by 12 months. That's why I said it was first year, all assets were bought 400,000, and they are saying both methods, the asset depreciation rate was 20%. And for both diminishing and straight line, you'll say 100,000 times 20%, then it will give you 20,000 depreciation for both methods. Then second year, for for straight line, it will be still 100,000 times 20%, it will be still 20,000. But for diminished balance method, you will say 100,000 cost price less accumulated depreciation from year one, because now you are calculating year two, which was 20,000. Then you will get 80,000 depreciable amount. Then you multiply by depreciation rate. Then it will give you 16,000 for depreciation for year two under diminishing balance method. Hello?
Sorry, I'm getting 96,000. I don't know how. I said
Where did you get
100,000.
96,000? Because remember, how much was the cost price of the asset? Or how can you give me depreciation for both methods first year? It was 20,000. If you say 100,000 minus 20,000, it will give you 80,000. Then you say 80,000 times 20%, it will give you 16,000 depreciation for diminished balance method for year two. And for straight line, it will be 20,000 for all the years. I don't know,
Oh,
where
sorry.
did you?
Oh,
Then how
sorry, I
did
made a
you arrive at
mistake.
96,000?
Made the error while pressing the calculator. Sorry, like it was the.
This method, there's no
Sorry,
difficulty from
Mkhobane.
this method. Yeah.
Yeah, I just noted on the slide, it says instead of carrying amount, it says accumulated depreciation. Hence, they were getting confused because I was checking now again. So
It's
it must be
saying
carrying amount.
where?
It says accumulated depreciation on the slide.
Under diminishing balance method.
No, when you go to slide number 9, what's that, bullet number 3.
Can you
So there
share
was a
the
typo there.
slide? Oh, I don't see the slide.
Oh, yeah, but I've posted there on the chat. So profit on sale of an asset is your proceeds less carrying amount. And I see Mabudusha Tem has also provided her calculations there on the chat. So please check there, and if you still don't understand, post there, then we'll give you clarity. Thank you. So you can continue, Mr. Mkhokon.
Yeah, let me do question, but I don't know how to split the screen. Let me share the question first. Let me share. I see whether they will see because it's a wet document. Let me. Hold on. Let me close screen. All of them. I can't see on the chat. They see my screen. Hello?
I think it's
Can you
still
all see
coming.
my screen?
Not yet. So while Mr.
Maybe let me
Mkhokwane
stop
is fixing
and
that,
share.
Mabaso, hey Mabaso, can we assist you while Mr. Mkhokwane is still sorting out? Yes, hey Mabaso, you can speak.
They can't see.
Yeah, I still can't see from my side.
Let me stop sharing and start afresh. I don't know what's going on my side. Can you see now?
Not yet. It might appear. Yes, we can see now.
Yes, I don't know because I don't know how to split the screen of the question and the solution. But first I will start with the question. Here we are given, this exercise is from FAC1502 under additional resources. Under study unit 11, we are given 11.10.2 revision exercise 2. Here you are given scenario. They are saying on 1st of January.
Wait, Mr. Mkhokwane, I think we can't see. There we go. Just give me a few seconds. The students can see, maybe still coming on their side.
No, we can see.
You can see. Okay.
Yes.
You can continue.
They can see. Let me do something.
Yes, we can see. It says there 11.10.2 revision exercise 2.
Yeah, let me start reading. Maybe let me start with the required. Here we are given the required. They are saying prepare the following ledger accounts, properly balanced and closed off for the year ended 31st December 20.3, and they want us to do the following general ledger accounts. Machinery at cost, which is an asset. And remember, asset increases on the debit and reduces on the credit. You must remember when doing the transaction. And the second required is general ledger accounts for depreciation, which is an expense. It also increases on the debit side and reduces on the credit side. And the third one is accumulated
Sorry, Mr. Mkogone.
depreciation. Yes.
Yeah, it seems like there's quite a number of students that can't see. Can you stop sharing and share again? Let's try this because I see on the chat there's quite a number of students that cannot see, but I have posted the question on the chat and the required. Please advise if you can see now. Okay. So I think, yes. Let me see if these are the same students that. So everyone can see. So you can continue. I did share with them on the chat this part and the next part. So you can continue and let them do the exercise like each separately so that they can understand. So
Yeah,
you can
here,
just, yeah.
here we are given 11.10.2 revision exercise 2. Maybe I'm saying let's first read the required. Here the required saying prepare the following ledger accounts properly balanced and closed off for the year ended 31st December 20.3. Here we already know the financial year end, which is 31st December 20.3. If you are given the financial year period, now you must determine the beginning of the financial period. You must go back 12 months, then determine the start of the financial period. And they are saying we must do machinery, general ledger accounts, which is an asset, and we set asset increase on the debit and decreases on the credit side. And the second required, they are saying we must do depreciation account, which is an expense, and we set expense increases on the debit side and reduces on the credit side. And the third one, they are saying we must do accumulated depreciation general ledger account, which is a contra account, which increases on the credit side and reduces on the debit side. And the last one is machinery realization, where we disposed of the machinery. This was the last required. There are 4 required things. Let me go to the beginning. They are saying on 1st January 20.1, because they are saying our year ended was 31st December 20.3. That means the financial year starts on 1 January 20.3. Then on 1st of January 20.1, it means 2 years ago. If you go back to December 20.3, December 20.2, then this thing it was 2 years ago. Because it will be December 31st December 2020, 20.1, 31st December 20.2. Then our financial year start on 1st of January 20.3. They are saying BBOC. BBOC is the name of the individual person, started an entity. B Printers. B Printers is the name of our business, and bought a printing machine The machine is called Zebra for 40,000 cash. This machine was bought for 40,000 cash. If maybe here, if you want to analyze the transaction, wants to get which account you debit, which account you credited. Here the business bought for 40,000. That means 40,000 went out of the business bank account. That means the business bank account went down by 40,000. That means we credit the bank account, which is an asset, by 40,000, and we debit printing machine by 40,000. Then let's go to the next transaction. They are saying on 1st of October 20.2, he bought additional printing machine, the machine called Jaqua, on credit from AB Machinery for 60,000 and paid a deposit of 10,000. Here before our current financial period, because remember our current financial period start on 1st of January 20.3. Before our 3 months before is October, November, December. 3 months before our current financial period, they bought additional printing machine, Jaqua, by 60,000 and paid a deposit of 10,000. If you want to analyze this transaction, because they bought on credit, that means a liability, which is a creditor. AB Machinery is involved. The other accounts, the two accounts will be AB Machinery, which is our liability. And remember, liability increases when it increases on the credit side and decreases on the debit side. Here we credit our AB Machinery for 60,000. And because we bought printing machinery, our machinery in the business increases, then we debit printing machinery for 60,000 and we credit liability, AB Machinery, for 60,000. And they're saying we paid a deposit of 10,000. Deposit is upfront payment, which will be treated as a liability. It will not form part of the cost. Maybe the question saying determine the cost price of the machinery. Remember, we said cost price is purchase price. You less your trade discount, and you add your installation cost. You less your interest cost. You less your maintenance cost. This deposit will not form part of the cost price of the machinery. Then, if I go to the next transaction, they are saying the Zebra machine became obsolete. The machine is no longer in use. It became obsolete. And BP Printers, our business, decided to purchase a cheater machine. Now we bought a machine from ZYP company for 100,000. The Zebra machine was accepted as a trade-in, valued at 15,000. The cheater machine was installed on 1st July 20.3, and BP Printers paid 5,000 for installation cost. Remember, installation cost will form part of your cost price. If maybe they require, say, calculate depreciation, you will say you will take the cost, you add your installation cost, then you will get the total cost price. And then here on the additional information, they're saying additional information A. Depreciation on the Zebra and Jaguar machine is provided for at 20% per annum on the straight line method. And additional information B. The estimated lifespan of the cheater machine is 8 years. And the estimated trade-in value at the end of the term is 9,000. Because remember, we said when you calculate depreciation, depreciable amount will be your cost price less your residual value. That will give you depreciable amount. I don't know whether to move through, or is there any question before we look at is there any question on the scenarios given? Is there
No,
any questions?
they are responding each other on the chat, so we still sorted. You can continue.
The problem is I can't share the both of them. Let me see. Now I must go to the required. And the first required is saying calculate. The first required is saying prepare the following general ledger accounts for machinery at cost. Machinery at cost. How many machinery do we have here? We have the first one was bought here. What's the first machinery? It was printing B. It was printing machine from we.
Mkhokone, you are muted. So while we are waiting for Mr. Mkhokone to come back to us, I have provided you with the slides just to see how we calculate each machinery. So we've got different types of machinery here. We've got zebra, we've got cheetah, we've got jaguar. And please, on the scenario, it's clear which one was new, which one was old, which one was sold. And then we also have the depreciation method that was provided on the scenario. And we were told about the year end is 31st of December. If you haven't seen it, it is there on the chat I've provided you. So meaning that at the beginning of the year for the year would be 1st Jan. So now, with us continuing on the side while waiting for him to display. So let's start with the first machinery that we had. So it says on 1 Jan 20.1, BBook started an entity, BB Printers, and bought a printing machine, Zebra, for 40,000 cash. So let's start with Zebra. So it was bought at 20.1. And which year are we calculating the carrying amount? So I want you to start. Let's look at the carrying amount for Zebra. Zebra and Jaguar machine is provided 20%. So we know that Zebra is 20% per annum. And now we are on which year? Year 3, because it was bought 1st Jan 20.1, 2, and 3. So meaning we do have an accumulated depreciation, we will have a carrying amount. Do we have any residual value for the, do we have a residual value for the Zebra machine? Please post on the chat, because I don't see the residual value here. That is for cheetah. So we must be careful. Let me see if Mr. Mkhokon, you'll let me know when you are back. Let me try to share from my side. Because I didn't put it on my presentation. Okay. Can you all see the scenario on the chat? Let me see. Okay, I'll try share my screen. Okay. Okay. Let me get to. So you can see my screen. I'm trying to see how I can navigate the two because I'm using one screen. So we've got a Zebra machine, which was bought on 1st Jan 20.1 for cash for 40,000. On the second line, they are talking about the Jacqua machine. On the third paragraph, they said Zebra machine became obsolete and BB Printers decided to purchase a cheetah machine from ZYP company for 100,000. The Zebra machine was accepted as a trade-in value at 15,000. So how much? Remember, we disposed this machinery. So when we say something obsolete, it means we can't use it anymore. Sorry, because I'm alone, can I put someone just to help me if I'm not muted? I don't know, Tanazil, are you still here? Okay, let me unmute you, allow mic. Thank you, Tanazile. I just allowed you.
Yes, you are audible. We can hear you.
Okay, so I just given you some rights. Case while we're still waiting for Mr. Mkhokoni to come back to us.
Okay.
Thank you, Tanazile. So when we say something is obsolete, it means we can't make use of it. So they decided to replace it by buying a cheetah machinery. But when they sold, they disposed this, this company ZYP allowed them to trade in this machinery for 15,000, meaning that the 15,000, it becomes like our proceeds that we get from that. So meaning that when you calculate your profit and loss, you'll have to take the 15,000 into account as your proceed. The cheetah machine was installed on 1 Jan 20.3. BB paid 5,000 installation cost. So this is for the cheetah machine. So let's see. Let's try to calculate for the Zebra machine. At least let's get what is our profit. What is your accumulated depreciation? What is your carrying amount on the date of sale? So when did they dispose this machinery? 1 January 20.3. Am I correct? So let's see, post it there on the chat. Yes, we are using the straight line method. If you check on the chat on the before the required, it did indicate that they are using straight line method. So now you'll have to give me the carrying amount. Did we make a profit or not? And please post you want the question again? Let me post it for you. I posted for you. Sorry. It's getting, yeah. We will deal with the required. Now I just want you guys to show me that you have understood what we have been discussing. Thank you very much. We are on the right track, and I will. So have you calculated? So meaning that we're going to show this on our realization account. Let me share my screen with you. Can you all see my screen? So you are correct. We made a loss of 5,000. The 15,000, which was ZYP that agreed to trade in, to pay us, give us a trade in. We did not get this money into our bank account, but they allowed to take that as Zebra machine and value it at 15,000. Then we had our accumulated depreciation. And remember, we bought this machinery for 40,000. So because this is the only machine that was sold, and this is the machine that is going to appear on our machine realization account, which is our required number 4. Can you see how easy it is? Very easy. So now, when we are done with the Zebra machine, let's go to Jaqua machinery. So on 1 October 20.1, we bought an additional printing machine, Jaqua, on credit from AB Machinery for 60,000 and paid a deposit of 10,000. And we're told that Jaqua machine is provided for at 20% per annum on a straight line method. So you will have to calculate for me accumulated depreciation and carrying amount at 20.3. So remember, it was bought 1st October 20.1, 20.2. And now I need the carrying amount at 31st December 20.3. And depreciation for 20.3. Because those are the amounts that we need to go and put it into our ledger accounts. So you'll get depreciation for 20.3, accumulated depreciation for 20.3, and carrying amount for 20.3. We know the cost price is 60,000 already. So now we are on Jaqua machinery. So now, what I need you to give me now, the depreciation for the current year. Remember, we said year end is 31st December 20.3. So I need the depreciation carrying amount. Do not combine them. Accumulated depreciation. So I need these three figures. Are you back, Mr. Mkhogon?
Yes, I'm back. I don't know what happened.
No, I think it's technical issues. So we are done doing the realization account, and now we are busy trying to calculate depreciation, carrying amount, and accumulated depreciation of the Jaqua machinery. So if we can check on the chat, the students are posting their attempts before we can give them the correct answers to see how if they are able to calculate the depreciation for that Jaqua machinery, then the carrying amount and accumulated depreciation before we can show them how do they post these amounts in that ledger. Then you can take over.
Where are you now? Are you on required B?
So what we're doing, we're just doing machine by machine. So we are done doing required number 4. We started with the zebra machine. So now we are making the calculations on the side before we post it in the ledger.
Or you
So
did
now,
you
yes,
did the
zebra.
calculations for depreciation?
Yes, for zebra, then we calculated the profit and we posted that in the ledger on the realization. Now the students are trying to calculate the depreciation and accumulated depreciation and carrying amount of the Jaqua machinery to say if it was bought on 1st October 20.2 at the year end in December, 31st December 20.3, what is the depreciation, the accumulated depreciation, and also the carrying amount. If you can see, they are posting there on the chat. Then you can continue. Then they can now calculate the one for the cheetah once they are done.
Yeah, I see on the chat.
Yes. So now, students, can you calculate the one for cheetah? Remember, we have indicated that the cheetah, if you check on the chat where I've posted the scenario, the cheetah was installed 1 July 20.3. So meaning in the current financial period. And BB printers paid 5,000 installation cost. So you need to decide if this 5,000 installation cost will be included as the cost price of the machinery, yes or not. Then you must also remember that you gave them Zebra machine, which was valued at 15,000 as a trade-in. So now, please post before we start anything, the cost price of the cheetah machine. Samhokwana, you can take over.
Yes, I see they're saying 105 because it's correct. Let me share. Yeah, because it was correct, because they bought it for, it was purchased for 100,000. And they install it, the installation cost was 5,000. And we said the cost price was, the purchase price is cost price. You add your installation cost, if there is an installation cost, you less your trade discount. If trade discount is given, you less your settlement discount received. Yeah, it's correct. The 5,000 is the cost price. Sorry, the 105 is the purchase price of the cheetah machine. Now we want depreciation for the current financial period of the cheetah machine. Remember, current financial period started from 1st of January 20.3 to 31st December 20.3, and they are saying the lifespan, useful life of the machine is 8 years. And we are also given the residual value of 9,000. Can they calculate depreciation for the current financial period? Let me check on the chat.
Samhokwana, you can display the required, like the information scenario only. They said they can't see, but I did share it twice on the chat.
This is the scenario. They can see the scenario.
No, you're not sharing. You can share.
I'm not sharing. Let me share.
Unless if it's my view, but I can't see anything. Yeah, something is coming. Okay, sorted. So they can see that, then you can continue.
Yes, here we want the depreciation for the cheetah machine, and they're saying the estimated lifespan of the cheetah machine is 5 years. And the estimated trade-in value, which is the residual value, at the end of the term is 9,000. And they said they bought the cheetah machine for 100,000, and they installed the machine on 1st of July 20.3 for 5,000 installation cost. And we said purchase price, it will be the cost price, the purchase price, which is 100,000 plus the installation cost of 5,000. It will give them 105,000. Divide by 8 years, because this 105,000 is the cost. Then you less your trade-in value, which is residual value of 9,000. Then if you say 105 minus 9,000, it will give you 96,000. Then you divide by 8 years. This is the useful life is given. Then you multiply by because the cheetah machine was purchased when 1st of July 20.3. Then you will say July, August, September, October, November, December, 6 months. Then it will be 105 minus 9,000 divided by 8 years times 6 divided by 12. 6 months is from 1 July to 31st December 20.3. Then it will give you 6,000 depreciation of the cheetah machine. Are you all okay with the 6,000? Do you understand how we calculated the 6,000? Is there any questions on the 6,000? Is there any questions on the 6,000?
No, they said no, we understand. No, we don't understand. No questions. They said explain again. Can you explain again?
Let's go to they see my screen.
Yes, we can see your screen.
Because Additional information B saying the estimated lifespan of the cheetah machine is 8 years. This is the useful life of the cheetah machine. And saying the estimated trade-in value at the end of the term is 9,000. And remember, you said when your depreciable amount is your cost price less your residual value, which is how much? Residual value is 9,000. And if we go back to additional information, they are saying the zebra machine became obsolete, no longer in use. The zebra machine we bought on 1st of January, this machine, it became obsolete, and BP printers, our business, decided to purchase a cheetah machine from ZYB company for 100,000. We bought the machine for 100,000. This was the purchase price of the machine. Then they are saying the machine was accepted as a trade-in value at 15,000. The cheetah machine was installed on 1st July 20.3 and BP printers paid 5,000 installation cost. And remember, we said when we determine the purchase price or the cost price of the machinery, we'll take the purchase price, which is 100,000, and we add the installation cost of 5,000. Then if you add this two amount, they will give you 105,000. Then you less your 9,000, which is the residual value, because now we are calculating the depreciable amount. And we said depreciable amount is your cost price of 105 minus your 9,000 of residual value. They will give you depreciable amount of 96,000. Then we'll say 96,000 divided by 8 years, which is the useful life. And terms, because the machine was installed during the year, you'll say July, August, September, October, November, December, 6 months. Times 6 divided by 12, number of months divided by 12 months. Then they will give you 6,000 depreciation for the cheetah machine for the current financial period. There's no question on this one? Is there any
hands? No. You can continue.
Now I must calculate, because you said you are done with the, let me check.
You can post, you can do the required. They've got the amount.
Or I can do the required for all 4 general ledger accounts. Let me explain the required. You mean the required for all 4 general ledger accounts?
Yes.
The first one, the required one, was machinery at cost. Remember, we said machinery is an asset, and we said asset increases on the debit and decreases on the credit side. And the required say, what the required say, let's go to the required, prepare the following ledger accounts properly balanced and closed off for the year ended 31st December 20.3. Remember, the year start when? 1st of January 20.3 and ended 31st December 20.3. That means the previous year, 20.2, it will be the closing balance, but it will be the opening balance for the current financial period. If they see here, they see this 100,000, this 100,000 is for the previous 2 machine, which is the, let me go to the, so that they can see. The 100,000 is for this machine bought on 1st of January 20.1 for 60,000. And there's also this machine again bought on 1st of October for What again for 60,000? If you add both 40 and 60,000, because they are closing balance from previous years. If you add both, they will give you opening balance for the current financial period. Because remember, current financial period is 1 January 20.3. Then this 31st December 2022, it was the closing balance of the last period. Then it will be opening balance for the current period. That's why here under our solution, they will see we have balance brought down for 100,000, which was the 60,000 and the 40,000 for both two machines. And on this 100,000, it was the new machine we bought from ZY company during the year. If we come here, they will see the Zebra machine became obsolete. That machine we bought on 1st of January 20.1, it was no longer in use. Then we decided to buy another machine which is called Cheetah machine from ZY company for 100,000. Then that's why on 1st of January, they can see the date here, July 1, we bought the machine from who? We bought this machine from ZY company for how much? For 100,000. Then on the same date, they said something about installation cost. And I said installation cost will form part of the cost price of the machinery. And I said, maybe if you want to generalize this, you'll debit your machine, Cheetah machine, and you'll credit your installation cost, which is bank, by 5,000. You debit Cheetah machine, which is installation cost, then you credit bank by 5,000. If we come here under our suggested solution, they will see our detail is bank by 5,000. Then we sold the machinery. This machine become obsolete, and we traded in for this Zebra machine. We traded in for Zebra machine. And how much did we bought the Zebra machine? We bought it for 40,000. Now we must remove it in our books because Zebra machine is no longer in the business. That's why we credited our assets account with 40,000. The machine we traded in of 40,000. If you add both sides, the 205 is bigger and the 40,000 is smaller. This will be the balance carried down. 165, 205 minus 40,000, it will give you 165,000, which will be the opening balance for January 20.4. They are clear on this general ledger account of machinery. Is there any questions? Is there any questions on the general ledger account for machinery?
There are currently no questions.
Let's move to the second required, which was the depreciation. I don't know whether they remember how they calculated the 4,000 of depreciation, which was the Zebra one. Because remember the Zebra, when was the Zebra machine bought? When was the Zebra machine bought? Or when was the Zebra machine bought? It was bought. Let's go to the Zebra machine was bought here. It was bought on 1st January 20.1. This Zebra machine for 40,000. And they are saying depreciation on the Zebra and Jaguar machine is provided for at 20% per annum on the straight line method. If for January 20.1, if you say 40,000 times 20%, it will give you another amount. Let's see. because it will be the whole 20.1. It will be 1st January 20.1 to 31st December 20.1. 40,000 times 20%, it will give you 8,000. Again, you come and calculate depreciation that 31st December 20.2. You'll say 40,000 again because it's straight line method times 20%. It will give you 8,000 again. This is the 8,000 plus 8,000. It will give you 16,000. That will be accumulated depreciation at the beginning of the current financial period. Then during the current financial period, we traded this zebra machine. For how much? For 15,000. But we bought the zebra machine for how much? For 40,000. Then we'll say 40,000. Now we are calculating depreciation for the current financial period. We'll say 40,000 times 20%, which is the rate which is given 20 over 100 times, because they are saying the machine was traded in 1st of July 20.3. Then you'll say January, February, March, April, May, June, because this is the beginning of July. Then it will be 6 months times 6 divided by 12. Depreciation for the current year for the zebra machine will be 4,000, because you'll say 40,000 times 20 over 100 times 6 divided by 12. 6, it comes from January, 1st January 20.3 to 30 June. To 30 June 20.3. If we can see here on the solution, we can see depreciation. This is the 4,000 that I'm talking about. Depreciation for the current year of the zebra machine is 4,000. Then there is 18,000. How did we get to the 18,000? This 18,000. Let's check the other one. Now we are looking for the 18,000. Let's go to the required. Let's go to the scenario. Now we are done with the zebra machine. Let's look at the other machine to get the 18. Is the 18,000. Let's go back because I don't remember the solution. Yes, it's the 18,000 for the on the debit side, 31st December 18,000. Let me come here. The 18,000, remember there was a cheetah machine. That one we bought on 1st of July. That one we traded in. That one we bought. So we traded in the zebra machine for the cheetah machine. How much was the cheetah machine? It was 100,000, which was the purchase price. And we add the installation cost of 5,000, it will be 105,000. And they are saying the estimated useful life, the lifespan of the cheetah machine is 8 years. And the residual value is 9,000, because we said depreciable amount is cost less residual value. Then we'll take cost, which is purchase price, plus installation cost. They will give you 105 minus residual value of 9,000. 105 minus 9,000. Let's see. It gives 96,000 depreciable amount. Then you will say 96,000 divided by 8 years, which is given. Times, because this machine was installed from 1st of July, you will say July, August, September, October, November, December, times 6 divided by 12. 96,000 divided by 8 times 6 divided by 12. It will give you 6,000. Depreciation for cheetah machine is 6,000. Now there is another machine, which is Jaguar machine. Remember, Jaguar machine was bought for how much? For 60,000. And for the current financial period ended 31st December 20.2, we said 60,000 times 20%, times 20 over 100, which is depreciation rate, times 3 over 12, because we will say October, November, December. Then for the current financial period, it will be 60,000 times 20, because we used this machinery for the whole current financial period. Then they will give you 12,000. If you say 12,000 plus 6,000, they will give you 18,000, which was here. Then if we add both sides, they will give you 22,000. And we said expenses and incomes are closed off to profit and loss account. That's why you see we close this account to profit and loss account. Is there any question on depreciation?
Currently, there are no questions posted.
Okay, let's move on to the accumulated depreciation. Remember, I said accumulated depreciation is the total depreciation. If you add all your depreciation, we called them accumulated depreciation. And remember, I said balance brought down. Balance brought down is the closing balance of the previous financial period. If you remember, we calculated 19,000 of this depreciation because it was from the two machine. It was from this machine, which is 40,000 times 20 over 100, the whole year from 1st of January 20.1. It was 40,000 times 20%. It was 8,000 for 20.1. For 20.2, it was 40,000 again times 20%, which was 8,000 again. If you add 8 plus 8, they will give you 16,000. Then for the Jacqua machine, we said 60,000 times 20%. 60,000 times 20% times 3 over 12, because we calculate October, November, December. Then they will give you 3,000. 3,000 plus 16,000. Then they will give you 19,000 here. The 19,000, it was from previous months. And the 4,000 and the 8,000, remember, we said debit accumulated depreciation, debit depreciation, credit accumulated depreciation. These two, they are from here, from depreciation account. These two, they are from depreciation account.
We do have some questions now. Can we just pause on that 18,000? We have a question where they are saying, can you please explain once more how we got the 18,000?
The 18,000, for the 18,000 is coming from here. The 18,000 is coming from Jacqua machine. Let's see Jacqua machine. Remember, this machine was bought when? 1st of October 20.2. 2020, 20.2, we said 60,000 times 20% times 3 over 12, but it was from previous year. Then it was never sold. During the current financial period, we said 60,000 times 20%. How much 60,000 times 20%?
12,000.
12,000. Then we have cheetah machine, the one we bought for 100,000. And that one, there is also installation cost. Remember, there is installation cost. How much is the installation cost? 5,000. If you add 100, the cost price of 100,000, the purchase price of 100,000 plus the installation cost of 5,000, they will give you 105, which is the cost price. And we said depreciable amount is cost price less residual value. And here they said the estimated useful life of the cheetah machine is 8 years, and the estimated trade-in value was 9,000. If you say 105 minus 9,000, they will give you 96,000. And you said 96,000 divided by useful life, divide by 8, they will give you 12,000. And 12,000 plus 6,000 is how much?
18,000.
I think this is the 18,000 here. This is for the two machine. They are all happy?
Okay, let me check the other questions. They said, can you please explain why we are not taking into account the 3-month period of 1 October to December? I'm not sure now where this question is coming from. Yeah.
Oh, 1 October, that one was the previous. Remember, we are doing journal entries for the current financial period. That one, it will form part of the balance brought down. Those ones will form part of the balance brought down. If we need depreciation for the previous years, maybe those ones will form part of the balance brought down.
Yes, that's correct, because we are now in 20.3. And then the next question is, the accumulated depreciation of December 31 is for Jaguar and Cheetah only. That's the clarity that they're trying to confirm. The accumulated depreciation at 31 December, is it for Jaguar?
Yeah, it was for Jaguar and Cheetah. Yes. Remember, the zebra machine was no longer there because we created the zebra machine.
And they're saying, why are we not including the machine price?
Machine price where?
I'm not quite sure. I think as part of the question.
Because the machine price is when we calculate depreciation. We'll say cost price for Cheetah. It was how much for Cheetah? It was 100,000 plus. Let me go to the Cheetah machine. It was 100,000. The purchase price plus the installation cost. They will give you the cost price. They will give you the cost price of 105, and we said depreciable amount is cost price less your residual value. Then we'll say 105 minus 9,000, they will give you 96,000. Divide by 8, then you calculate your times 6 over 12, because this was installed 1st of January. Then you get your accumulated depreciation.
Okay, I think we have just 2 more questions and then we're done with questions. The first question is, how did we get 22,000? And the last one is, how did we get 19,000?
The 22,000, or we addressed it, is the 4,000 for depreciation for Zebra for the current financial period. Because they remember Zebra was traded in. Zebra was traded in during the current financial period. Let me go here. The Zebra machine here, this machine was bought here and was traded in. The Zebra machine became obsolete. The machine was no longer in use. Then we traded in for Cheetah machine. Where? 1st of July. Then you will say 40,000 times 20%. Because they are saying the Zebra machine is 20%. Times January, February, March, April, May, June, times 6 over 12. Then they will get the 4,000 for the Zebra machine for the current financial period. And the other one was the 18,000. We explained the 18,000 many times because it was this machine, the Jaguar machine.
Yeah, no, they want to know the 19,000.
19,000.
The balance brought down.
Which 19,000? Let's go. Where is
yes,
the
the balance brought down on accumulated depreciation.
Remember, this is the previous accumulated previous total accumulated depreciation for 20.1 and 20.2 added together. They will form part of total accumulated depreciation, and they will become opening balance for the current financial period, which starts 1st of January 20.3. This is the previous total accumulated depreciation for the two machine, for the Jaguar. For this one, for 2021, it was 40,000 times 20%, 40,000 times 20 divided by 100 for 20.1. Financial period ended 31st December 20.1. It will be 40,000 times 20%. It will be 40,000 times 20%. It will give you 8,000. Then for the next financial period, which ended 31st December 20.2, it will be 40,000 again because it's a straight line method. Times 20% is 8 again. 8 plus 8 is how much? Is 16,000. Then the other one will be 60,000 times 20 again, times 3 over 12, which is how much?
3,000.
3,000 plus 16,000 is how much?
19,000.
This is the 19,000. Is the opening balance, which was the previous accumulated depreciation. Then it becomes the opening balance of the current financial period. Is there any questions?
No, there are no more questions. I think Nombeko and Clara did try to respond to the other questions that the students had.
And then the other one, this one, the machine realization. This one, they must remember the 6 steps of asset disposal, because with the other step saying, take out the total accumulated depreciation on the assets that were disposed of from the date the assets was purchased until the assets was sold. That one we take to the realization account, the 20,000. Let me explain the 20,000. How did we get the 20,000? The total accumulated depreciation of the previous year. They must, which machine was disposed of? They must remember which machine was disposed of. According to our scenario, it was only Zebra.
Yeah.
And they must, the first, how much was the accumulated depreciation of the Zebra? It was 31 December 20.1, it was 4,000. 31st December, it was 8,000. 40,000 times 20%, how much? Is what? It was 8,000 for 31st December 20.1. It was 8,000 again for 31st December 20.2, and it was 4,000 during the current year. How much? 18, it will be 22,000. This is the total accumulated depreciation of the disposed assets. This is the total accumulated depreciation of the Zebra machine. Because the other step, it was step 2 saying, take out the total accumulated depreciation on the assets that were disposed of from the date the assets was purchased until the assets was sold. Here we take this out because remember, accumulated depreciation is a contra account and we open it with the credit balance. To reduce the credit balance, we must debit. To take this out, we must reduce by debiting this thing. Then we are taking the 20,000 to realization account. And the realization account is here, is given here, realization account. This is the 20,000 that I'm talking about. This is the 20,000. Because we said take out the total accumulated depreciation of the assets that were disposed from the date the assets was purchased until the date the asset was sold to the credit side of the realization account. This is the 20,000. And the other step is take out the cost price of the disposed assets and transfer it to the debit side of the realization account, which is the disposed assets, is the zebra machine. How much is the cost price of the zebra machine? It's given here. The cost price of the zebra machine. The other step, take out the cost price of the disposed assets and transfer it to the debit side of the realization account. We followed the step. Here is about following the step. We followed the step here. This is the other step we followed. Maybe it's step 3. I don't remember. If they refer to understudy unit 11, they can see the step. Maybe this is one of the steps. And the other one, I think we followed all the steps. The other one is the trade-in value. The 15,000 it was given here, trade-in value. We traded in the machine, trade-in value. That one was also given where we debited the asset and credited realization account. This one, we debited our assets by 15,000, we credited our realization account. Then this the loss. They know how to calculate the loss. It will depend. If proceeds is greater than carrying amount of the assets at the date of disposal, then it will be profit on disposal. If proceeds or carrying amount is greater than proceeds at the date of the disposal, then it will be loss. This one is they calculated it, the 5,000. This is the calculation. This is the opening balance, 100,000. This is the depreciation for Zebra and Jaguar machine of the 19,000. This is the depreciation for the current financial period for the Zebra machine. This one is for the Zebra machine, Jaguar. I don't know whether there's any questions.
I think we've covered them all.
Because they must go and revise. If they want to realization account, they must go and revise the steps. There is how many steps? 6 steps. If I remember, there are 6 steps of how to calculate, how to do realization account. If you follow the steps, realization account is not difficult because you just follow the steps. The steps are given under study unit. Is under study unit 11. There are steps given there. They must just follow the steps and calculate when calculating general ledger account of when doing general ledger account of realization account. There are 6 steps from study unit 11, under study unit 11. They will get the steps dealing with the disposal of an asset. I'm not sure whether is there any questions.
No, I think they've all been responded to. Yeah, we don't have any more questions.
Let me stop sharing. Yeah, we'll post the slide. Yes, we'll post the slides. Without any questions, maybe we must end the session, and student must work hard for assessment 3. It's opening 1st of October and closing 8th of October. It will be on the system for 8 days. Thank you everyone for attending the class. Good luck with assessment 3.
Thank you. Goodbye and good night.
Bye. Night. Good
Thank you.
night.
Bye.